Hello, friends. Now I would like to discuss the last part of your unit number 5, credit rating. So this is a seventh lecture series, the last lecture of unit 5. We will discuss in this lecture series the 5 important aspects which are to be covered for the topic venture capital. The first one is stages in venture capital funding, exit route of venture capital in India, venture capital funding institutions in India, and these are the things, disadvantages and all that we have already discussed in the previous lectures. Now here, in our previous lecture series, we have already seen the venture capital funding process, methods of financing venture capital, and all the related things. And now the last point that we need to discuss is stages in venture capital funding. Remember, venture capital is not funded once for all. It is not funded once. It is funded in divided stages. Normally, for example, any venture capital investor who is investing in a new project does not invest the full amount at a one single stretch. Say, for example, if the project is around 10 crore rupees, a new project, for example, a mobile, the mobile radiation cutting device, for example, if it is to be produced, it will not be produced, this venture will not be invested full amount at a single stage. So the investment is made in part by part by the venture capital investing organization in the new projects. These are calculated, these are considered to be stages of funding. There are two important stages, three important stages which are divided into three. One is early stage financing, the second one is expansion financing, and third one is acquisition or buyout financing. Three different levels of financing. Early stage financing is called as is classified into again three sub stages. Early financing in the sense, in the beginning of the project, in the beginning of the new venture activity, the funding is made in the first stage, that is called as early stage. Early stage is divided into three basic stages. One is seed financing. Seed financing is defined as a small amount that an entrepreneur receives for the purpose of being eligible for a startup loan. For example, seed financing is a financing made for developing the project report, getting the testings and all that for that particular product, and making eligible to apply for the loan or apply for the further funding requirements. So an entrepreneur, when he comes out with a new project, the idea is only experimented in laboratory or only experimented in certain small niche area. So if it has to come to a common market, or if the large scale production has to happen, lot of activities needs to be done. The product needs to be registered, patent has to be taken, or the product needs to be tested in the laboratory for continuously to see the quality. And or if for example, if the product is already ready, you should make it eligible to test by the persons and all that, inspect by the third persons. So to this stage, a seed financing is made to make the product eligible and develop a business plan for application for the further one. The second stage is, after the seed financing is done, startup financing is given to companies for the purpose of finishing the development of the products and services. For finishing purpose and all that, the startup fund is given. The first stage financing, the third one, companies that have spent all their starting capital and need financing for beginning a business activities at the full scale, for the major beneficiaries of the first stage financing in the for the purpose of giving a reward to the entrepreneurs, or sorry, for venture capitalist. If the widened market production has to be made to cover the wide market, in such cases the first stage financing is made. So this is early stage financing activity by the venture capitalist. The second one is expansion financing. In this case, when the business is already established to certain level, Say for example, the business is sufficient enough to cover the local market. If the business has to cover the national market, international market, and expand its business, they open new branches, open new production units. In this case, expansion financing is most essential. Expansion finance may be categorized into second stage financing. It is called a second stage financing, and bridge financing, and third stage financing, or mezzanine financing. Second stage financing is provided to companies for the purpose of beginning their expansion. Say for example, opening the branches, or going for higher more production quantity, increasing the quantity of production, etc. This is called expansion. It is also known as a mezzanine financing, means developing financing. It is provided for the purpose of assisting a particular company to expand in a major way. Once it expands, the second point also covers is the bridge financing, may be provided as a short-term interest only finance options, as well as for monetary assistance to companies that em employ the initial public offers for the major business strategy. If at all, for any additional international level and all that, if the company is going for market issue, the initial public offer for investing the money from the open public, in such cases for initial public offers and all that, this bridge finance is given. So most of the companies will not go for this kind of a bridge financing under venture capital, because venture capitalists themselves will buy the shares of that particular company. Normally they go for when it goes for the initial public offers, majority of the equity shares are held by the venture capitalist. Only if the venture capital investment is so big that venture capitalist capital is not sufficient and expansion is beyond the capital investment of the venture capitalist, then the companies may go for initial public offers. In such cases, any kind of expenditures required for that particular this thing, the venture capitalist is going to finance for the initial public offers and all that. That is called bridge financing, means financing for bridging the income to be increased or investment to be increased. It bridges the gap of the venture capitalist investment and the expectations of the investment in the business. If the expectation of the business in the invest is more than the venture capitalist capabilities, the shortage of that particular funds is being financed through outsource, that is initial public offers and all that. So this kind of financing is called bridge financing. The third financing stage, or the C-level stage, is acquisition or buyout financing. Acquisition or buyout financing is categorized into acquisition finance and management or leveraged buyout finance. Acquisition financing assists a company to acquire certain parts of an entire company. Management or leverage buyout financing helps a particular management group to obtain a particular product or another company. In this case, acquisition refers to when the company wants to expand. In expansion level, suppose if at all the existing venture capital company, venture capital established business wants to acquire the business of some competitors or some weak kind of businesses, then financing is made to acquire that particular company. So here acquisition is what you call as getting the weaker companies. And buying means purchasing that particular other company's total assets. In acquisition also purchasing happens, but the shares are transferred, but the assets and all that will be in the name of the small company which is running, acquired company will be having. In case of buyout, the whole industry is purchased and the existing business unit's name will continue. That is what we call as merger, acquisition and buyout. Acquisition plus buyout. Here all the assets are bought by the company. Acquisition financing assists a company to acquire certain parts or entire company. Management or leveraged buyout means particular product. Management or leveraged means the acquisition of some part of the company, some part of product of the company that is only acquired, not the whole company is acquired, but one particular product is being acquired. For example, if the Crompton Greaves company has to be bought by some foreign big company, The Crompton Greaves company is producing a lot of variety of products. It produces fans, it produces washing machine, it produces uh, electrical goods and all that. But the foreign company will acquire only part of it. That is called leveraged buyout. That is a particular product. Leveraged buyout means the product which is having a more leverage, more profitability, that product line itself only will be bought, not the whole company. Now the patents of producing that particular brand is being bought by the other company. So in this case, acquisition happens not fully but partially. But in case of financing assistance for acquiring a certain parts of the entire company, it is called as acquisition. Whereas particular part acquisition is called as management or leveraged buyout. So these are the various kinds of venture capital funding possibilities. In this case, venture capitalist is going to assist the entrepreneur to come out with the venture capital organizations. Now, the exit route of venture capital, how an venture capital business will come to an end. There are various exit options for venture capital to cash out their investment. The venture capital investor can liquidate his investment in the business and come out from that particular venture capital agreement in different ways. There are four different ways of completing or coming an end to a venture capital proposal. One is IPO, initial public offer. The venture capitalist himself can sell out all the shares that he has held in the particular business and liquidate his asset through initial public offer, because lot of shares are already held by the venture capitalist. Most of the assets are in his name. The venture capitalist can convert these assets into shares, and shares will be sold in an initial public offer. That is how we call as IPOs will come to an end for the venture capital. After IPO, the business will become a private or public limited organization, not a venture capital organization. Before that, venture capitalist was the only owner and all the powers were enjoyed by him. When the business cannot be managed, when the business becomes bigger one, normally venture capitalist will come out from the business and sells it at a higher rates and earns a abnormal profit, that is capital gain in the IPO. Then promoter buyback in the sense, in this case, the promoter or the entrepreneur who has generated an idea where the venture capitalist has invested, the promoter himself may buy all the shares of the venture capital investors, and make the company owned by the entrepreneur. That is also possible. That is called, we call as promoter buyback. Mergers and acquisitions, in this case, mergers and all that, the venture capitalist may sell out the whole of these assets to some other company and merge the company to others. Or if the venture capital organization is acquired by some big companies also, venture capital investments will come to an end. Sale or other strategic investor, if at all it can be sold to some other investors. Say for example, national level venture capital investors may sell it to international level venture capitalist, then where the rights of that particular organization will be handed over to somebody else. It is similar to sale also, but here the whole securities are bought by a single person, but is venture capital investment institution, from national level to international level, or from local level to national level. Like that, transfer of that venture capital will be made, because the local venture capitalist will sell it to national level venture capitalist, where the big company will acquire. Say for example, the in case of VRL, you might have seen the VRL was producing Vijay paper, right? Vijay Karnataka paper, and it is bought by Times of India, and it is Times of India has become the capital investor in that, where the strategic investors has come out, where the name of that particular Vijayawani has not changed, and still it is operating in the market, which is belongs to Vijayawani belongs to that is Vijay Shankeshwar, the local entrepreneur of Karnataka. So venture capital funding in India, if you see, the funding of venture capital concept started in 1987 by Industrial Development Bank of India. For giving a strength for capital investments to IDBI, the government of India levied a 5% cess on all know-how import payments to create the venture fund. Government of India has levied a 5% cess on all imports payments. If at all imports have been made, when the payment is to be made by the Indian importer to foreigners. So on all payments, government has levied a cess of 5%, where the total import payments 5% has been taken away, and that 5% money what is generated by the government is kept under one single heading called venture capital, and IDBI is given that particular fund to finance for the new startups, business organizations and all that. ICICI also started the venture capital in the same year, in the year 1987. Later on, ICICI floated a separate venture capital company called TDICI, uh, Term Deposit and Investment Corporation of India, TDCI, was developed, and through that, the term deposit collected from the public was given to the investors. That is new for business proposals, and venture capital concept has been levied out. Venture capital funding institutions in India, if you see venture capital nowadays, there are a lot of venture capital organizations coming out. These are classified into those promoted by the central government, those promoted by the state government, and those promoted by the public banks. There are three different levels of promotional activities happened in the venture capital investments. The central government has developed the venture capital organizations under the name ICICI Venture Capital Fund, Venture Funds Limited, Industrial Credit and Investment Corporation of India. Then IFCI Venture Capital Funds Limited, that is IVCF, uh, uh, Institutional Financing and Credit Investment Venture Capital Funds Limited. Yes, SIDBI, Small Industrial Development Bank of India Venture Capital Limited, that is Small Industrial Development Bank, also developed a venture capital with the government support. The venture capital fund was created and it was dispersed to the new entrepreneurs to come out with the new projects. Those promoted by state governments controlled development finance institutions are Punjab Infotech Venture Fund, developed by Punjab state government. Gujarat has also developed a Gujarat Venture Finance Limited, GVFL, and Kerala government also developed a Kerala Venture Capital Fund Private Limited. Apart from this, there are some promoted by public banks also, that is nationalized bank. We have Canara Bank Venture Capital Fund, SBI Capital Market Finance Funds. So these are the two different. Can Bank is venture capital is doing extensively good, supporting for all the local or village entrepreneurs and bringing up the entrepreneurial level and investing huge amount of money in the new projects. And those promoted by private sector companies, we have IL&FS Trust Company Limited, Infinity Venture Capital Venture in India Limited, and there is again those established as a overseas venture capital fund, that is a foreign companies come out with venture capital investments for India. That is, we have Walden International Investment Group and Hong Kong Shanghai Bank Corporation Private Limited, HSBC, Equity Management, then Equity Management, Mauritius company it is. It has also opened its branches in India to help the Indian entrepreneurs to come out with the venture capital proposals. Apart from this, many local or national level renowned entrepreneurs may act as a venture capital. It is at an individual level. Say, for example, Infosys is also having the venture capital attitude to invest money in the software related entrepreneurial developments and all that. We have Tata, we have Birla, and Bajaj. Bajaj Auto is also investing money in the small businesses and venture capitals and developing those kinds of things. They are investing in the ancillary industries, especially the Bajaj, the Tatas, the Birlas. They invest in the ancillary industries, that those who are supplying the input items for their big organizations, to motivate these small entrepreneurs to come out with the raw material supply for these industries. They are investing funds in that, so that it will help both. It will help the entrepreneurs also. It will help the big companies like Tata, Birla also to get the quality materials on time. So these are the discussions relating to venture capital. promotions in India. So I thank all the students for listening patiently. And here the model fifth will get over. And tomorrow onwards, we will start with the model sixth, the last model, mutual fund. That is a biggest topic, but it covers a lot of aspects in it. So please prepare well for this model for you. I will also send the PPTs after the completion of the syllabus. Thank you one and all. Any queries and questions, please raise in WhatsApp group so that I can address those queries.